welcome to another episode of Business in the Know. And this time we actually have a guest who brings real expertise about money to the table. Paul Benton has arranged for Bugra Bakan to talk to us about how to stop overspending. I've spent my whole life on the other side, revenue generation. There comes a point in your business when you're running your business that you have to pay attention to the pennies. Welcome. Good morning, gentlemen.
Good morning, Mike. Welcome, everyone, and welcome, Bugra. I read this book, Stop Overspending. I got a lot out of it. And as I shared with you, Bugra, this book is a book of philosophy. It's a tour through philosophy, biology, psychology, and finance on how a business owner is to conduct personal financial affairs. And I learned a lot from this book. Let's jump right in. The thrust of the book is spreadsheets don't help you. That's not the answer. What is?
Yes, first, thanks for having me. Spreadsheets don't work because they do not address the main part of the problem, main reason for the problem. And main reason for the problem is such a complex issue. Excel sheets, and in many ways we do this all the time. We offer simple solutions to complex problems, and we delude ourselves thinking we have an answer, all the while we don't. It's better to say I don't have an answer than thinking that you have the answer while you don't. The problem is so complex. It has to do with emotions. It has to do with brain biology. It has to do with social pressures. It has to do with the system we live in. To say that, hey, here's an Excel sheet is, in my mind, similar to giving someone a pair of sneakers who says, hey, I want to go run and get in shape. The problem isn't not knowing that you have to get out and run. The problem is the execution. Execution is the key. Same with budgeting. Everyone knows that they have to spend less than what they make so they can secure their future financial obligations. The question is, why can't you do it? And how to do it. And that's what I tried to answer with the book.
And you've come up with something called the integrated wealth theory. And as I read it, it's a fusion of culture, of government, of understanding capitalism, your brain wiring, time, and even the meaning of life. So that is a large topic. How can you make it understood for us in a nutshell? Because it's really fascinating. It's more of a philosophy as much as it is a method. Tell us.
Absolutely. I called it integrated wealth theory because it's an interdisciplinary way of looking at how you can better manage your personal finances. Without understanding the capitalist system we are in, our political system, without understanding how your brain biology reacts when you get that package from Amazon, without understanding your emotional needs and what happens to those when they are not met, and what immediate knee-jerk actions you give. If you don't understand these, you'll never be able to tackle the budgeting problem. So integrated wealth theory, what I try to do is over time, this whole thing evolved by people asking me the questions, and I have not been able to give them a good resource to go to. So I felt the need that there's a lack of resources for people who can go to and they want to manage their finances, personal finances better. And over time, when I started reading about it, learning about it, and mostly thinking about it, and mostly internalizing and looking back at my own history, own personal story, that's where the philosophy comes in. I realized there's so much missing, and just to say, hey, here's one side of the story, it's kind of like having a car. You can't drive a car with one wheel. You have to have all four wheels. You have to have the steering wheel. You have to have the engine. If you miss one of those, it's great to have a car, but it's not going to go. Same thing with managing anything that has to do with the person. It's such a complex being. I try to bring awareness and bring people's attention and start a conversation more so than saying, here's the answer. It really is an attempt to start a conversation, and hopefully other people will come in and improve the book, come up with better, smarter ideas. So integrated wealth theory looks at, aims to combine all these areas and find a smarter answer.
And to to offer an analogy, mine, not yours, um, this is a little bit like demystifying the matrix. You're explaining that first there is a matrix. What is it?
Yep.
What is our relationship to it? And once you understand that relationship, you're empowered to break free. And that's anyway the lens I read with the book, and I found it very powerful. Let's pick one theme, which is by way of illustration. What is frugality? That's a theme in the book, and it's not obvious what your book means by it as that word is defined in the dictionary. So explain to us, and that's a big topic, but explain to us what you mean by frugality.
Excuse me. Before I answer that, I like your linear train of thought. One of my favorite, if not my favorite philosopher, I'll call him a philosopher, is Buddha. It's a very Buddhist way of looking at it. There's suffering, there's cause of suffering, there's solution to suffering. It's like there's a matrix, there's a cause for a matrix, and there's a solution to matrix. But you first have to say, okay, there's a matrix, and then you have to go in that linear fashion. And that's what I try to do with the book as well. So I like your analogy. It fits right in. Frugality, at least the way I see it is, if you consume less than what you produce, or easier way to say, if you spend less than what you make, and you set yourself up for securing your future financial obligations, in my mind, you are a frugal person. Now, most people will say, yeah, but how about Bill Gates? How about Warren Buffett? I mean, this formula doesn't apply to them. But there's a formula even for them. And there's a topic in economics called the law of diminishing returns, the law of diminishing marginal returns. And here's how it works. If you haven't had a glass of water for 2 or 3 days, the first glass of water can save your life. It's critical. The second glass of water, still so critical, but not as much as first. The third keeps diminishing. The benefit you get from that glass of water keeps diminishing. And there comes a point where you're actually going to reject the water. So I don't want it. So for people like Bill Gates, how this works is you're from a $5 to a $50 burger. I'm sure there's a difference in quality and the taste and the experience. Between $50 to a $500 burger, there could still be some differences in quality and the taste and the experience. But there comes a point where additional dollar doesn't bring any more value. And even for Bill Gates, that's where he would have maxed out the marginal return on the increasing his dollar of expanding, putting money into the burger. So that's where he should stop. So even for Bill Gates, there's no sense in paying more to burger, which he's not going to get any additional benefit by adding another dollar to it. So for people like us, spend less than what you make, secure your future financial obligations. That's frugality in my mind. But if that doesn't apply to you, stop where you maxed out the marginal return on the additional dollars spent. That's the formula for people to whom the first formula doesn't apply.
And that's actually a good segue into some practical do's and don'ts. What would you say, talk about a savings rate, what is a good rule of thumb for folks in Marin County in an affluent area that are not engaging in luxury, but what is good, healthy savings as a percentage of your income? Are you advising your clients?
This is one of those complex questions that cannot be answered simply. Any financial advisor, financial planner watching this would hate if I just throw a number out there, because it's like saying, what's a healthy weight? Well, how tall are you? Or are you athletic? What's your body type? How much should I save? How much do you want to have at retirement? What's your starting assets? How much do you make? So there's no easy question, but I would ask forgiveness for betraying my profession, and I'll throw a number because people love these kinds of uh,
That's why I asked it.
rules of thumbs. Please forgive me. I would say if you're in your 20s, 10% of your gross income, and for every decade, add 5% to it. So in your 30s, 15, 40s, 20, 50s, 25, and 60s, 30% of your income. That's my rule of thumb. If you find this too much,
So your savings
talk to a
rate,
financial planner.
your
Yeah.
savings rate should become in your 60s 30% of your income.
Yep.
That's
Especially
powerful.
if you failed in your, especially if you failed in your 20s, and especially if you didn't invest well from your 20s. If you started early, you may not have to do this. Again, um, the reason why I said it's a simple answer to this complex question won't work, and the reason why probably financial advisors and planners watching this would hate my guts for saying this is because it really depends on when you started and where you want to end. But assuming your income is going to grow and assuming you will have, you're not going to have to buy a house in your 60s, you already did that. You're not going to have to send kids to college. You've already done that. So you have more discretionary income amount that you can save, and that's why the idea is that you can increase as time goes on. You're gonna make maybe twice, three times as much as you were making when you started in your 20s. That's the idea, but that doesn't always work like that. That's the reality.
And you, throughout the book, you have a principle, quote, pay yourself first. What do you mean by that?
Yes. So most people, when they set themselves out to save, what they do is, okay, I'm gonna have all these expenses, and whatever is left, I'm gonna save, which fails because you will always have some things to buy. You'll always have a vacation to go to. You'll always have a new car. And the challenge is the more you make, the more you will spend as a result. Because now you can go buy that nicer car, bigger house. You can go on to that or go on that European vacation. So it's a formula that is designed to fail. But you have to flip that. If you flip that equation and if you pay yourself first, which means if you say, okay, I'm going to take that 10% and put it in a savings account or brokerage account that gets invested even better, then we all know we've been there. You will make do. You will spend less. We all know if something happens and if you start making less, you're going to adjust to it. We've all been there, we've all done it. So if you pay yourself first, set your account up to an automatic transfer to a brokerage account. Technology allows us that. It's so easy now. Just set up an ACH monthly, um, quarterly, annual, depending on if you're a business. It could be difficult, but at the year end, um, write a check to yourself, to your brokerage account, to your investment account, to your saving account first. Then whatever is left, go have fun with it. There's nothing wrong with having fun with the money you made as long as you did the responsible thing, set money aside to secure your future financial obligations. Once you've done that, go to that European vacation. There's nothing wrong.
And does this is a good principle. Have you seen it applied well in business? Are you advising clients to take a look at this mental map for the business affairs as well as just their personal?
Um, Absolutely. If you have set up your, this is easier for businesses that are established than entrepreneurs because entrepreneurs, their focus is more on improving their revenues, improving their market share, improving their profit margins. But for businesses that are established, you can say, we're going to have an automatic transfer to your 401k accounts. Beautiful. If you encourage your employees, partners to take a portion of their 401 salaries and go to a 401k to max out their contribution, they don't even see it. Beautiful. And it helps with taxes. It grows tax deferred. Um, it's a beautiful way of forcing us to be responsible, because a lot of us, for the reasons I have outlined in my book, it's very difficult to do. Now, if you're an entrepreneur, your goal is to go out and conquer the world and improve a profit share, and your cash flow is sporadic. I get that. But even for them, I think the reality is there will come a point where we won't be able to work and produce, meaning produce income. We have to think about that. So even for entrepreneurs, and we also go through business cycles. This is where a lot of entrepreneurs fail to do. They think when they do well, they think they'll always do well, but business cycles happen. We just went through one of them last year unexpectedly. But every 5 to 7 years, we go through business cycles. So you have to create a cushion for that as well. So for businesses, this is absolutely applicable. Then you're not going to have to. Like, one thing we learned, I know our time is limited, but I have clients work in the Silicon Valley, and I ask them what they're going to do with COVID and other crises to come, and they said what they learned. This was a senior executive in Google in 2008 and 9. They have laid off a lot of people, but it cost them so much money to go and get them in 2010 and 11 and 12, because those talents are gone either back to their countries or to different industries, or they lost the talent. So they set aside so much money so they can keep their employees for 2 years, even if they don't make money. So they're not going to go have to hire and retrain those people. So it is important to set money aside for long list of reasons.
And that's a Google, obviously a different kind of company, but the mindset, that idea that if I, as a small business owner, at some point I go from entrepreneur to business owner in a stable business, otherwise I go crazy. So at that point, I need to begin to start thinking about a war chest, right? I need to be able, and coming through as we sit here in the beginning of 2021, we have learned a valuable lesson. Those businesses with zero war chest, probably not going to be with us. It's hard to, and I don't want you to go out on a limb for a number in your industry again, but, and I don't know that there is a number for a business to have percentage wise, but a great piece of advice I got many years ago was if you got 6 months worth of expenses in the bank, you're golden. Now, depending on the business, that's kind of tough, but this mindset for small business, how does that really play out?
Tough one. It all depends on if the owner can be removed from the equation, and if he or she cannot be. For instance, Mike, if you are the main producer of the company, that number, 3 months may not be enough, because what if you have a disability? What if you're sick? What if you have other people who are sick or disabled in your life that you have to take care for? So in financial planning, this is what we tell our clients, and I will segue to the business. If you are a single breadwinner, you need 6 months worth of expenses. If you are a dual breadwinner, dual income, then you need 3, because then if something happens to one income, there's the other two coming and help. So that depends on the business too, how it's structured. How is your income sources diversified or not? For instance, if you're GE, you have electric, you have home appliances, but if you're only selling software, so that also depends on how diversified your income sources are. I would say a year, but you just said 6 months is tough, because when a recession hits, it will hit for a year, 2 years. Recessions do last. After 2008, this is another maybe topic for another show, because there's so much money printed. The government did not allow for a recession, so we are now in the longest economic growth in history. We don't have this 12, 13-year growth ever before. The last one that came close to was Bill Gates' years, but even that's nowhere near. So every 5 years we go through recessions that last about 2 years. So the question is, what are you going to do for those 2 years? You have to be able to answer that, because if you can't, then just like what happened in Corona, so many businesses were paycheck to paycheck. 2 months, 3 months, no income, boom, the business is gone. And it's so unfortunate, it's so heartbreaking, but that's the reality of it.
It must be, it's difficult because as a business owner who's growing, you can't get into the nickel and diming stuff because I don't think that that's particularly productive. But I did recently watch, this is before the COVID, so, you know, it was a little bit ago. I did watch a restaurant owner friend of mine spend $150,000 on equipment because he wanted it new, as opposed to about $25,000 that he could have bought for used. And I love new stuff, but man, I think we just really need to start digging into these decisions, because we can either increase revenue, cut expenses, but it has to probably be a little bit of a balance till we build that war chest. If I'm hearing you right, it sounds like I need a little
Absolutely.
more.
No, absolutely. You know, I know Paul wants to say something, but it's very important. How I would decide whether or not I will take that extra is return on investment. If you're making a $150,000 investment to your business, and if you know the return on that is going to pay that and more, it's like that game. If I give you 10, if you're going to give me back 11, I'll play that game until cows come home. But if you are just doing it because if you can't quantify it, this is the most important part. If you didn't sit down and write and quantify the return investment on that additional expense, you didn't do your homework, so don't do it. Right. And you have to be realistic.
This is a book full of, it's a college PhD course, and we don't have time to cover it all, but I would love, Paul probably has one last question, but I'd like to begin the end by saying, man, I hope we have you back pretty soon, because I'd like to dig into some of this more detail.
I think what would be good in closing, Bugra, is just to note, you yourself are an entrepreneur in your own right. You founded your company, you built it over more than a decade. And in doing so, you found time to write a book. So for other professional service firms out there who are not in the writing profession, can you just give us a few pointers on how did you come to the process as a wealth manager to sit down and write a book? And the book is meaty, but yet very readable. And so it isn't what's so common among business books full of exclamation points and colorful graphics. This is a really readable, deep distillation of great ideas. How did you sit down to write it, and what tips do you have for other entrepreneurs who might be able to express themselves with a book they might write? Any words of wisdom? And then
yeah, I would say have an idea book. Literally have a physical book with a pen. I have these pens that I love writing with. I hate writing, but I like writing with old style ball pens. And it helps me jot down ideas. So have an idea book. Every time an idea comes, we know we do have ideas and we forget them or we don't act on them. Start writing these ideas. Ask questions to yourself. If you ask the right questions, it's a very important skill to have, is to know what questions to ask. And man, each time a client asks me a question, I don't know the answer, it bothers me. So I start digging and ideas start coming and I jot them in my idea book. And that's how the integrated wealth theory came about. I read, I listened podcasts, and once I felt like, okay, I have something meaty enough to share with other people, then I wrote a book, and it looks terrible. it had no flow at all. I wrote it again. I wrote it again. It took me 4 or 5 times, and each time my wife read it, she was my first editor. First time she's like, this makes no sense, Bugra. Only you will know what's in this. So it took me 5, 6 copies until it had a flow.
Over how
and
many
I
years?
still now go. So the actual writing of the book took me 2 years, but 2 years is the version that you're reading. It took me maybe another 2 years of the versions that you'll never read. So I would say keep writing, just like anything else. If you want to be a good basketball player, go get the ball and start shooting. Right? It's just numbers game. Start writing. Never be shy. The biggest problem writers have, I had it for years, is what they call writer's block. You think you're not good enough, your writing isn't good enough, people won't like it. Probably that's true, but it will get better. Keep writing, have an idea book, write again, have your friends read it, have your spouse read it, have your father, someone who's an avid reader like you, Paul. I would, if I had I known, you would be the first reader. I would say, hey, Paul, you'll probably go, don't do this to me again. This is terrible. That's what I would say. Keep your focus, keep writing, keep bring your ideas together, because we all have that in us. It's just we don't act on it. Just act on it. Execution.
Thank you for watching another episode of Business in the Know. I hope, like us, you learned a little something today. Let's go out there and meet some new people, tell some good stories about our business, and while we're at it, make a couple bucks.